All right, today we're stepping into what feels like a parallel financial universe. It's huge, it's growing, and it runs on a core principle that is completely the opposite of the system most of us know. We're talking about a world without interest, but believe me, it is definitely not a world without money. So, let's get right into it.
Just look at this number for a second, $1.6 trillion. And get this, that was the estimated size of Islamic financial assets way back in 2012. That's bigger than the entire economy of countries like Australia or Spain at the time. So yeah, this is not some tiny niche market. We're talking about a global financial force that's been growing like crazy ever since.
And that brings us to the central puzzle, right? I mean, we're all taught that interest is the engine of finance. It's the price of money, it's the reward for taking a risk. So how on earth can a system worth trillions of dollars even function, let alone thrive, by completely banning it? Answering that question is the key to understanding this entire alternative economy. Okay, so let's dive in. To really get our heads around this, we have to start with the one foundational rule that changes absolutely everything about how money works. It's a concept that basically throws out the idea of lending for profit and replaces it with a framework built on partnership, real-world value, and ethics.
And that rule all comes down to one word, riba. In Arabic, it means an excess or an increase. But in finance, it specifically means interest. You see, the core idea here is that money itself shouldn't be a commodity. You can't just make more money from money alone, without some kind of productive activity happening underneath. Instead of a lender just sitting back and charging interest, this system is designed to channel money into actual investments that earn a tangible profit.
So if you can't have interest, what do you have instead? Well, you get a set of ethical principles. First, equity and fairness. Basically, business shouldn't be about tricking someone or taking advantage of what they don't know. Second, ethical enterprise. The money can't be used for things considered harmful, like gambling or weapons. And third, and this is the big one, profit from activity. Your return has to come from something real, something productive. Think profits from a sale or rent from using an asset. It's a fundamental shift from just lending to actually participating.
All right, let's see how this actually works in the real world. If you're a big company and you can't issue a traditional bond because, well, it pays interest, how do you raise a ton of capital? The answer is the single most important instrument in Islamic finance, something called a sukuk. If you can wrap your head around this, you can understand the whole system in action.
So what in the world is a sukuk? Well, here's the official definition from the big standard-setting body, IFI. And I want you to laser focus on one word here, ownership. See, a sukuk is not a debt instrument. It's a certificate that proves you own a piece of something real, a building, a fleet of airplanes, the right to use an asset. It's basically a title deed, not an IOU.
And this slide really lays the whole thing bare. With a regular bond, you're a lender. Simple. You give a company money, they owe you that money back plus interest. You own a piece of their debt. But with a sukuk, you are an owner. You use your money to buy a share of an actual tangible asset. The return you get isn't interest. It's your slice of the profit that asset generates, like rent payments. And believe me, that shift from being a lender to being an owner changes everything.
But, of course, it gets a little more complicated. Not all sukuk are created equal. In the real world, they've kind of evolved into two main flavors. And the difference between them is absolutely critical if you want to understand the real risks and rewards involved. It's the difference between something that looks and feels like a conventional loan and something that represents true, honest-to-goodness shared ownership. Okay, let's walk through the first type, asset-based. Imagine a company, we'll call it the obligor, needs cash. So investors give their money to a new, separate legal entity, a special purpose vehicle, or SPV. The SPV then uses that cash to buy an asset from the obligor, let's say that's their headquarters building. Then, the SPV immediately leases that same building right back to the original company. The company pays rent, and the SPV passes those payments on to the investors. But here is the key part. If the company stops paying rent, the investors can go after the company itself to get their money. So, at the end of the day, it functions a lot like a secured loan.
Now, let's look at the other kind, asset-backed. This one is way closer to the pure theory we've been talking about. Again, investors pay an SPV. But this time, the SPV buys a portfolio of assets that are already generating income. Think about a collection of properties that are already leased out to different people. The income from those assets flows to the SPV, which then passes it to the investors.
In this model, the investors truly own the assets. If those assets don't perform well, the investors take the hit. All the risks and all the rewards of ownership are on them.
So here's the bottom line. Even though they're both called sukuk, they have completely different risk profiles. The asset-based structure, where you can go after the original company, acts a whole lot like debt. But the asset-backed structure, where you own the assets outright and you sink or swim with them, well, that is much more like owning equity, like owning a stock. And this little distinction becomes incredibly important when things start to go wrong.
Now, theory is one thing, but how do these complicated instruments actually hold up under pressure in the real world? To figure that out, we're going to look at two huge case studies, both from Dubai, that perfectly show both the incredible promise and the hidden dangers of sukuk finance.
So first up, the success story. This quote is from the chairman of Emirates Group right after the airline successfully paid back its first ever sukuk in 2012. And it's a huge deal because it shows how this financial tool became a core part of the strategy for one of the biggest airlines in the world, especially during a really rocky time for global markets.
The timing here was just critical. After the 2008 financial meltdown, the traditional debt markets, especially the European banks that Emirates used to rely on, got very, very nervous. They just weren't lending. But Emirates had this massive growing fleet of airplanes, real, tangible, valuable assets. So they used those planes as the basis for sukuk, tapping into this whole other pool of Islamic capital that was still liquid. They raised hundreds of millions this way, and in doing so, they proved that sukuk wasn't just some niche product. It was a tough, viable tool that a global giant could use to get through a crisis.
But for every amazing success story, there's usually a cautionary tale. And while Emirates was showing the world how sukuk could work perfectly, another huge company in Dubai was about to cause a crisis that would shake the entire Islamic finance industry to its core and expose all of its hidden flaws. Let's talk about Dubai World.
The whole thing unfolded with terrifying speed. In late November 2009, Dubai World, the state's giant investment fund, just suddenly announced it needed to restructure its debt. And that included a $4 billion sukuk from its famous property developer, Nakheel. You know, the company behind those palm tree-shaped islands? Then came the bombshell. An official from the Dubai Finance Department came out and said point blank that the government did not guarantee these debts. The market went into total panic. Everyone had just assumed the state would back these companies. In the end, a last-minute $10 billion bailout from the neighboring Emirate of Abu Dhabi saved the day, but the damage to confidence was huge.
So what went so disastrously wrong? Well, first, the legal fine print was murky. Investors thought they owned the underlying land, but what they actually had was a 50-year leasehold, which, under the law at the time, wasn't considered a real enforceable property right. Their ownership was on shaky ground. Second, investors were running on a bad assumption. Even though the official document said there was no government guarantee, the market just assumed there was one. And third, the whole structure was too complex. The guarantee that did exist came from the parent company, Dubai World, which was in just as much financial trouble. It was just a perfect storm of legal loopholes and wishful thinking.
The stories of Emirates and Nakheel really capture the two sides of this coin perfectly. So let's zoom back out. What have we learned here? What is the true potential of this system, and what are the deep-seated challenges it has to overcome to get there?
The promise here is huge. You can't deny it. The ethical focus means that, in theory, business should actually benefit the community. By tying finance to real assets and forcing the money provider and the entrepreneur to share risk, you can create a more stable financial system, one that's less likely to create the kinds of speculative bubbles that have caused so many crises. It encourages a long-term view. And on a practical level, it unlocks these enormous pools of capital for businesses all over the world, Muslim and non-Muslim alike, that are looking for new ways to get funding.
But the pitfalls are just as real. This is not an easy system to run. The products themselves are really complex. They have to comply with Sharia principles and with conventional financial law, which just piles on the legal and administrative costs. Innovation can be slow because every new idea has to be approved by a Sharia board. The partnership model also requires a much higher level of trust and oversight. And finally, by just banning certain things like speculation, the system is simply less flexible and can't react as quickly as its conventional counterpart.
Which leaves us with the big question for the future. We've seen its potential for stability, for ethical investment, powerfully shown by companies like Emirates. But we've also seen how complexity and unclear rules, like in the Nakheel disaster, can create massive risk. So, is this a blueprint for a better, more stable global financial system that's actually tied to the real economy?
Or will its inherent complexity and costs mean it will always be a powerful but ultimately separate niche in the world of finance? The answer to that is going to shape economies for decades.